Hey everyone, welcome back to the channel. If you're new here, on this channel, we break down all things related to investments, personal finance, and wealth-building strategies. Today, we're diving into the world of equity, one of the fundamental concepts in investing. If you've ever wondered what it means to buy shares in a company or how your ownership in a business works, this video is for you. So let's start with the basics. What exactly is equity? In simple terms, equity refers to ownership. In the investment world, equity means owning a piece of a company or asset. Let's break it down into two main areas where we encounter equity: equity in companies and equity in real estate. First, when you buy stock or shares in a company, you are buying a piece of that company. This means you own a small fraction of its assets, earnings, and any potential growth. That's equity in action. You're an owner. Now let's focus on equity investing in the stock market. When you buy shares of a company, you're essentially becoming a shareholder, meaning you own a part of that company. This equity gives you rights, like the ability to vote on major company decisions and to potentially receive dividends if the company shares profits. But remember, equity can also come with risk. The value of your shares can fluctuate depending on the company's performance, market conditions, and a range of other factors. While equities can provide strong returns, they can also be volatile. A well-performing company can see its stock price soar, but a struggling company can cause its stock price to plummet. Now, it's important to understand equity versus debt. A lot of new investors get confused by these two terms. When you invest in debt, you're essentially lending money to a company, usually through bonds. In return, the company promises to pay you interest over time and repay your principal at maturity. This is different from equity, where you own a part of the company and your returns depend on the company's success. Equity tends for higher rewards. Equity also plays a big role in real estate investments. In this case, equity refers to the difference between the value of the property and the amount owed on any mortgage. For example, if you buy a house for $300,000 and you have $100,000 left on your mortgage, your equity in the property is $200,000. As property values rise and you pay down your mortgage, your equity grows. So why does equity matter for investors? Well, equity investing gives you the opportunity to grow your wealth over time. It's an essential tool for building long-term financial success. Here's why. Potential for growth. Companies that grow and perform well reward shareholders with increasing stock prices. Ownership benefits. You get a slice of the company, including voting rights and sometimes dividends. Inflation hedge. Over time, well-performing equity investments can outpace inflation, helping you protect your purchasing power. But before you jump into the world of equity investing, it's important to recognize the risks involved. As an equity investor, you're exposed to market volatility. Your investment might lose value in the short term due to changes in the economy, company performance, or unexpected events like a market crash. Market risk. Overall market downturns can hurt equity prices. Company risk. If the company underperforms or goes bankrupt, your equity could lose value or become worthless. Volatility. Stock prices can rise or fall dramatically in short periods. But with proper research and a solid strategy, you can manage these risks and potentially reap the rewards. All right, so how do you get started with equity investing? Start with research. Learn about the companies you're interested in. Look at their financial health, growth potential, and industry trends. Diversify. Don't put all your money into one stock. Spread your investments across different companies and sectors to reduce risk. Consider ETFs or crowdfunding equity. These are great options for new investors who want exposure to a broad range of stocks without picking individual companies. Remember, equity investing is a long-term game. Patience is key. So that's the rundown on equity. We covered the basics, the risks, and why it's such an important concept for investors to understand. If you found this video helpful, be sure to like, subscribe, and hit that notification bell so you never miss out on new content. If you have any questions or want to dive deeper into specific topics, drop them in the comments below. Thanks for watching and happy investing.